Welcome to the daily update, where I'll go over the action in the market for Wednesday, January 17th, and then we'll see how things look for Thursday, January 18th. We had another down day. It could have been worse. We ended up closing up off of the worst levels of the day. But at the same time, we have some positive things that we can look at and some negative things that we can look at. What I'm going to try to do as I go through this is reach some kind of a conclusion, even though things are a little bit muddy right now. The first thing that we talk about is what happened right at the open. We did have a gap lower open. The futures did turn quite negative after the retail sales came out. Now, the futures were negative before, but then they kind of kicked into high gear after that. Prices fell down below S2 at 47.30. They attempted to rebound, and we did. We bounced back up, but we didn't get all the way back up to R1 at 47.48 when we did see the bounce happening. As the day went on, prices then fell back below S2 before finding support at around the 47.15 level. Then prices rebounded back above S2 and closed almost at the best level of the day. Now, we were down and we were gapping lower, but to see prices come back and repair a lot of damage going into the close, that's one of the positive things that we can look at. So we were down 0.56% on above average volume, just a little bit above average now. Our technicals were mixed. Now, we're positive in the bigger picture and in the longer term. We're even positive in all the different time frames, but there's some real negativity coming in as we continue to work off this extreme positive condition. Now we're starting to see some extreme negative readings, and the whole climate is kind of shifting a little bit more negative. Now, that could change back to being more positive at any time. As I always say, we just have to go with what we're being presented right now, and it's about inflation and interest rates, that the Fed is probably going to cut rates in 2024 unless things really change on a continual basis and they come in stronger than expected. It just may not be as soon as the market was anticipating. Some comments that we could make: small caps continue to underperform. This continues to be a disappointment. As of right now, it looks like the January effect happened in December. Rising interest rates did pressure stocks, and that's the same thing that we saw on Tuesday. As we are seeing stronger than expected economic reports coming out, that's pushing interest rates up. The interest rates going up are pressuring stocks, and so that's pushing prices down. Mega caps and growth did outperform. Now, they were down, but they were down less than some of the other areas. Especially with mega caps, they were down less than the broad market. Growth was down, but it was down less than value. And then European Central Bank President Lagarde, I think that's how you say that, Lagarde, I'm not, okay. Repeated comments that we're hearing now coming out of most of the central banks, including the Fed, is that, yeah, we're probably going to cut rates, but it might happen this summer. Then on a short-term basis, we still have our stochastics that are extreme positive, and we have an extreme negative reading here, not only with the VIX based on 9 periods, which is measuring sentiment, because we really spiked up with the VIX, but also with the Stoch RSI. And that's a pretty touchy indicator, not really a surprise when we have been chopping sideways and then we get a move in one direction or the other. This indicator is one of the first ones to register something extreme. In the intermediate term, we still have the PMO studies as well as the PMO oscillator. Now, this is where we're seeing a mixed signal, because you see the next part, we have the PMO studies giving us some extreme positive and extreme negative readings at the same time. You'll notice that the bullish percent index for the S&P, that dropped off the list, but the NASDAQ 100 bullish percent index is still there. Now, you can see it as negative because we did decline. We're right at 70 with the NASDAQ 100 bullish percent index. That, since it's dropping, that's more negative, but it's still giving us a very high reading overall, which you can take as positive. Also, our new high, new low study, that's just kind of camped out in extreme positive territory. And then we have the McClellan oscillator. And I tried to point this out in yesterday's video that we were going down with the market going sideways. Well, you throw in another decline, and that shot us into an extreme negative reading. In the long term, we're rolling over with our 150 and 200 period simple moving averages, but we're still extreme. And here's this scenario that the Fed might be done raising rates. Okay, the market's still going with that idea, but this is the variable. Are they going to rate cuts? If so, when? And The Fed has also come out and said that if we get stronger than expected economic reports, they might even consider raising rates. The dollar was up and interest rates were also up. We're getting up above that 4.02% level for the 10-year yield. We ended up closing at 4.11%. We still have the yield curves that we follow that remain inverted. Sentiment is positive. Now, this really fell. It had been at 70. With the downward move, it dropped all the way to 57. Now, it's above 50, so it's positive, but it has been declining now. And this is where we're seeing another change. The trend is now negative. The red line has crossed above the green line. The ADX continues to weaken since it's below its moving average. And our bias is negative, and I'm changing our momentum over to negative for right now. And I have a whole list here of economic reports. I'm not going to show charts of all these, just the major reports that came out. We had the weekly MBA mortgage applications index. It came in up 10.4%. Last week, it was up 9.9%. Now, this is taking into account when interest rates were going down, the market was doing better, and people are like, okay, if we're going to refinance, if we're going to get a mortgage, we need to do it right now, just in case interest rates start to go back up. And that's why we're seeing this continue to climb. And right now, that looked like a pretty wise choice to make. Retail sales, this is where the market really had some problems. They came in up 0.6%. Much higher than the 0.4% the market was expecting, and up double from what we saw last time, being up 0.3%. When you take out autos, also double from what we saw last time, coming in up 0.4%. Last time it was up 0.2%. Then export prices, this is where I don't have the charts. They came in being down 0.9%. Last time they were down 0.9%. Import prices, when you take out agriculture, we were down 0.9%. Last time we were down 1%. Import prices were unchanged. Last time they were down 0.5%. Export prices, when you take out oil, were unchanged, where last time they came in up 0.1%. Industrial production, this is another one. It came in up 0.1%. They expected it to be down 0.1%. Last time it was unchanged. Capacity utilization came in at 78.6. They had expected 78.8, so that's a little weaker than expected. Last time it came in at 78.6. Business inventories came in pretty much the same as last time, being down 0.1%. The NAHB Housing Market Index came in stronger than expected at 44. They had expected 38. Last time we had 37 for our reading. Here are some charts. Here's the MBA mortgage applications, where we've seen two back-to-back weeks of folks getting more applications for a mortgage. And then here is the retail sales based on a year-over-year reading. And I have to move this up here at the top. The core sales, where it's going back up, and it was stronger than expected. It's not really shooting up right now, but it is starting to turn back up where it had been flattening out. Then we look at the retail sales month over month, where it came in not really a huge reading, but it was stronger than what the market was expecting. Industrial production, that's the blue line, where it's going back up here, and capacity utilization is still flattening out. That's the gold line. Here's capacity utilization, also showing that it's flattening out, and it's still below 80. When we get to 80 or above, that means we're at full capacity at that point. And then month over month, we are showing an increase in industrial production. Here are business inventories, which continue to come in down, but not very much. And then the NAHB Housing Market Index, it's starting to come back up and is showing a real improvement there. And taken all together, the market is going, wait a minute, these are stronger than what we thought they would be. I don't have any Isabel Net blog charts. The charts that they were posting just didn't seem to really feed into things that we're seeing right now. Here's the intraday chart where we gapped lower. We immediately went down to S2, actually broke a little bit below that. We tried to rebound, but we never got back up to S1. Then we turned and broke down below S2. We came down around here to about the 47.15 level or so. And then this is where things started to turn a little more positive. And we saw that in yesterday's action, where we hit the low and then bounced up off of that. We hit the low and then started to recover. We got back above S2 and we saw some buying going into the close. So it was still negative, but to see later day movement like this on the 10-minute chart, that is encouraging. Here's our intraday chart for the SPY, where we just started off right when Europe opened. That's when things turn a lot more negative. And then here's where the retail sales report came out. Here's the negativity of the cash session. And we're pretty much unchanged in the initial overnight session. But this is one of the positive things now. We're still seeing the blue line above the red line. The blue line was actually positive when compared to the red line on an intraday basis. This is also encouraging, where we saw some weakness initially with the SPY growth to value ratio, but we spent most of the day clawing our way back. And when we look at the bigger picture here, we are showing some improvement. The end of day chart, everything was down, but growth was down less than value for the large caps, the mid caps as well, and quite a bit less when we look at the growth for the small caps. I wanted to show this chart. I haven't shown this in a few sessions here, where we're chopping sideways with the growth to value ratio for the small caps, but now we're coming up more to the higher end of this range that we've been in. That is positive for right now. The mid caps continue to be kind of breaking out just a little bit when we look at mid cap growth versus mid cap value. So this is another one of those positive things we can hang on to. And we are continuing to see some improvement with the growth to value ratio for the S&P. It's still in a downtrend, but it has been improving. Then this is another growth to value chart that I usually only show on the weekends, but this is just to show how it's not really falling apart here on this chart with the growth to value ratio. Then this is an area that's been causing a little bit of concern. Discretionary is underperforming staples, where we have discretionary going down. Staples also seeing some weakness. It's the ratio on the bottom that we follow the most. And as the market was trying to really go up here, we were seeing a negative divergence, and this ratio has been going down. Looking at our trend, this is where we're seeing a trend change here, where the ADX is weaker, and it's because it's below its moving average, but we're seeing the red line crossing above the green line. That means we're now slowly switching over to defaulting to the negative. And we're also seeing that on the short-term chart. The red line is crossing above the green line. We have a weakening trend below its moving average. Another day or so of this kind of action, we could actually go into a trendless environment in the short term. And we're still below average when we look at our volume over a period of a few days here. Here's sentiment, where we didn't really move much at all with the Ulcer Index. This is where we saw a little bit more movement. The VIX really turned up with the line chart as well as the bar chart. And we were pretty much sideways to slightly advancing here with the VIX of the VIX. We saw this really starting to go up. That could have been giving us a warning sign, but it's kind of settled down, at least for right now. This is the VIX placed on top of this is an RSI 9 period. We're just barely looking extreme. That means that the VIX has gone up pretty far, pretty fast, but it could still go higher than this. Here's the VIX to move ratio, showing that the VIX is really outperforming the move ratio, where we had been seeing this declining. Now we're starting to see it going back up. And here's the VIX to the 3-month average of the VIX. It has been declining, but now we're ticking back up. Here's the VIX to VVIX ratio, also declining, but we're flattening out. And here's the equity put call ratio, where actually we declined on a down day. And I'm a little bit later recording this because I really wanted to see these charts. Not really telling us all that much. They're kind of going against, we thought this would continue, or I would think this would continue to go up. And it is still going up when we look at the 5 period, and we're getting extreme. If at some point we can top out and start to come down, that could be positive for the market. Here's a longer term look showing other times when we had extreme positive readings. Eventually, when we finally do top out, and we don't really know when that will be, this ends up being positive for the market if you compare what happened below with the price chart above. Then our equity put call ratio based on 253 periods, it has been declining, but just ticking back up a little bit now. The risk on to risk off ratio, it was down, and it's pretty much been chopping sideways. We were hoping to see some kind of an improvement here, but it's the down day. This ended up being down as well. Looking at our advanced decline line, we're rolling over based on price. But if you notice the blue line here and the green line based on volume, you notice how volume is really leading things lower. And that's been a warning sign that we've been watching. And that's still continuing for right now. We're still pegged at the top with our 5 period moving average study of the new highs minus the new lows, but we continue to decline with our 10 period. and we're seeing just a little bit of an expansion of the new lows in our raw score. We're dropping below the midpoint with our short-term advanced decline ratio. We're still positive, even though we're declining with the longer-term advanced decline ratio. This is another positive sign. Accumulation distribution, it actually went up on a down day. Looking at the Chaikin money flow, continuing to decline. So that's a little bit more of a warning sign here, even though it was still positive. The cumulative NYSE advanced decline line really dropped here, and we're also going back down with our regular NYSE advanced decline line. We did decline based on price and volume, and notice where volume's going faster when you compare these two charts as we're going down. Our other advanced decline line is turning down. We're still working off of a recent golden cross with the advanced decline line. So we're coming back down close to the moving average. When we look at NYSE common stock, we rolled over, but we're still holding up a little bit better. When we look at the S&P, we're showing some weakness with the mid caps, and with the small caps, we're dropping below the moving average. Our short-term chart really looks like a big M right here now. We're not really seeing an awful lot of damage to this point when you take a bigger picture look. Now, this could develop into something, and some people are going, ooh, double top, ooh, double top. It may work out that way, but let's just be aware of that and try to work through this difficult time and see if the market can turn back and be more positive. On the bottom, we do see where volume ticked to above average. And no changes here with the decision point scorecard. Here's the Stochk RSI, which is already giving us an extreme negative reading. We're turning down with the 20, 50, and 200 period moving average study. This is another positive sign here. Yeah, we came down below the simple moving average, but we closed above the exponential moving average based on 20 periods. That can be taken as positive. This level is holding so far. We are dropping below zero with the force index. That's turning more negative. And here's our stochastic study. In the short term, we're declining and starting to go below the midpoint. We're no longer extreme in the intermediate short term, but we're still extreme in the long term, even though we're turning down slightly. And we're coming down right to the midpoint here with our standard deviations chart. And we were kind of dangling below our moving average study here with the double and triple exponential moving averages, just showing a little bit more weakness here. Intermediate term, the balance of power did decline, but it's still above the midpoint. We're turning a little bit more negative here with the go, no-go system. We're going from the dark blue bar to a light blue bar. And we're dropping just a little bit below the midpoint, and we pretty much closed right on that. So our intraday move took us below, but we ended up coming right back up. And the TTM squeeze, it's continuing to show more weakness, but it's still positive. In our double and triple exponential moving average study based on 50 periods, we're starting to drop below the double exponential moving average. That's the blue line. And we're dropping a little bit below the midpoint here with the ease of movement. The Erin indicator is no longer extreme positive. It's still positive, but it's rolling down after giving us an extreme positive reading. This is the one that I highlighted in yesterday's video. We're already extreme negative with the S&P McClellan oscillator. Now, it could go further than that, but to see this going down as price was going sideways, that could be a positive divergence. But we're still continuing to decline with the summation index based on price. And notice how volume has a lot more dots in the chart here. That just means it's been going down faster. So volume has been leading price. And we are declining with our NYSE McClellan oscillator, but we haven't gone extreme negative, at least yet. So we're going down with the NYSE summation index based on price and volume. And also notice how the volume is going down faster. We are more negative now with the Swenlin trading oscillator based on price and volume. We're below the midpoint and declining. And we're still extreme positive with the PMO. My goodness, we're below the moving average and it is declining. We're also declining based on price and declining even faster based on volume. But here, the PMOs that are rising, we're already extreme negative. The buy signals, barely extreme negative. The percent of PMOs above zero, extreme positive, even though it's still coming down. We've turned over to negative with the Elder's Impulse system for the S&P, but we're still positive with the parabolic SCR. So if we have another down day, we'll wonder if this can continue. The slope oscillator continues to decline. It was trying to show some improvement, but now is dropping further below its moving average. The MACD also had been trying to improve, but now is starting to look more negative. All of our oscillators were declining in the short term with the slope and the TSI. We're declining with the MACD, the PMO, and the PPO. We continue to decline in the long term with the TRIX and KST. And here's another look at the 20-period exponential moving average, where we have now lost the simple moving average. And here's the bullish percent index. It's no longer extreme. It dropped just barely down below 70. So now this is an official sell signal. We'll see if it continues to fall or if the market is able to stage some kind of a bounce from here. The NYSE bullish percent index is declining, but still above 50. The NASDAQ 100 bullish percent index, it's right at 70 now. So it's still extreme. If it drops a little bit, it's going to be a sell signal. If it goes back up, it will continue to be extreme positive. The Chaikin oscillator is actually showing a little bit of an improvement. This may be picking up on what we're seeing in the accumulation distribution and the Chaikin money flow, where those are holding up a little bit better on a down day. The money flow is below 50 and declining. That's negative. The ultimate oscillator was sideways, but this is still positive above 50. And we're seeing this negative too. With the vortex, the red line is crossing above the green line. The rate of change is no longer extreme positive. It finally came down. The RSI, and now that we're seeing a little bit more of a development here with the RSI based on 14 and 9 periods, you can see where we were coming back up to this previous high. We were not making that same high. So this is a negative divergence with the RSI. But when we look at just the movement for right now, we are declining, but we're above 50 based on 14 periods. We're right at about the midpoint based on 9 periods. Unbalanced volume did go down, but it's still above an advancing moving average. We're rolling over with our 200-period moving average study and showing a faster decline with our 50-period moving average study. We continue to be negative with the Copic curve. And this, I just wanted to point this out because we're below the midpoint with the Bollinger Bands. So that's why we're dropping below the midpoint with the percent B indicator. And the equal weight is underperforming the S&P 500 equal weight. And looking at the open, high, low, close, the mini rainbow, notice how we're still inside of this. We went down below it, but we closed inside of the rainbow. So for right now, this support is holding. Our different charts turning more negative with the Heiken Ashi. We're positive, but turning down with the Kegi. And the Renko redrew itself again here, and it's actually looking a little more negative. But the 3-line break is still hanging in there. It's not quite sure what it wants to do right now. Long term, we are declining with the 150 and 200, but we're still extreme positive. I wanted to bring this up. This is the soft landing versus hard landing scenario that we work with here. This is the S&P compared with 3 to 7 year bonds. Yeah, we're coming down, but we're not necessarily falling apart, at least to this point, suggesting that the market thinks we'll have a soft landing. We have been seeing economic weakness without necessarily going into a recession. I watch this chart every day, and if we really start to show some weakness here, I will be bringing this up. Also, we're still above this longer-term trend line. We did decline with the S&P weekly chart, but we're hanging in there when we look at this shorter-term look at this longer-term trend line. The different indexes, you can see where the equal weight. Oh, I'm sorry. This is the NYSE Advanced Decline Line. They look very similar to me. Where this is really showing some more weakness is the S&P's been holding up a little bit better. Here's the equal weight to S&P 500. When this ratio is going up, that means the mega caps held up better. We're also seeing this longer-term negative divergence. We're not too far from the all-time high with the Dow. We've been declining with the transports. That's showing a negative divergence. We also declined with utilities. And the transports continue to underperform the Dow. The ratio between the transports and the S&P continues to decline. That is negative. And the Dow just came down to this pivot point and was able to close above that. So this is holding together so far. The Dow is actually down 0.25%. The diamonds, though, still remain negative for the Elders Impulse system. The NASDAQ came down to this pivot point and closed well up off of the low. So far, this support level is holding. And we didn't come down to the pivot point with the NASDAQ 100. The positive thing here is that we ended up closing well off of the low for the session. And we switched over to neutral for the Elders Impulse system for the Qs. And here's the momentum for the NASDAQ 100. We were flattening out and trying to show some improvement, but we're turning back down below the moving average now. The small caps, this has been pretty disappointing. Here was the January effect, which seemed to all happen in December. Now we've been giving back a lot of these gains, and they're continuing to show more weakness. We are still negative with the Elders Impulse system with the small caps. When we look at the Russell 2000 small caps, we're well below this resistance level, which is what it's turning into, but we're still above this support level. We're declining with the RSI. We're declining on a momentum basis, but the long-term trend is still positive. The mid caps holding up a little bit better here, but have now fallen further below this pivot point. And they've also remained at negative for the Elders Impulse system when looking at the mid caps. The FANG index, yeah, it was down over 0.5%, but we're not too far from that all-time high. The financial sector hadn't shown this in a few days. This has really been showing a lot of improvement as we were finishing out 2023. And then even the start of 2024, this was holding up. But since the banks started to report, we've been seeing this coming back down in the short term. Here's the tech sector to the 3 to 7 year bond ETF, where this is still continuing to look pretty positive here. Then we look at the Qs to the 3 to 7 year bond ETF. This is also hanging in there. It's not falling apart, at least yet. The dollar is going back up now, so that's showing some improvement where it had been declining, but it did generate a recent death cross with the trend. Here is the rise in the 10-year yield and the fall in the 10-year based on price, but we are seeing a golden cross based on price. Then looking at our growth to value charts here, we're seeing some improvement with the Qs to S&P. That's continuing to go up. The area of concern is discretionary to the S&P, and that was the discretionary to staples chart that I also showed. That's continuing to fall off. That's a warning sign. But we are seeing large cap growth outperforming large cap value. When we look at our different growth to value ratios, large caps, mid caps, and small caps are showing some improvement here. So this is more positive. Our 10-day average of the S&P 500 highs minus the lows, we're still camped out in extreme positive territory here. And we're dropping a little bit below zero with our highs minus the lows, a 5-period moving average. And then we look at the Amex, NASDAQ, and NYSE. This had been positive. Now it's starting to turn back more negative. Then our 50-period new highs, new lows study for the S&P, we actually turned back up just a little bit here. And we're above zero. So that's positive in the longer term, but we had been declining, but we showed a little bit of an improvement here on this chart. The S&P to utilities ratio is continuing to go up. This may give support to the S&P. That could be positive. So what's our outlook for Thursday? Is the January effect over? I keep asking that, and we keep having to say, okay, let me try that again. I keep having to say that it might be, but it could come back, but it hasn't come back yet. The technicals, we are still positive when we take everything together. Although we are showing some weakness and our ADX charts are starting to turn back more negative. So far, the 20-period exponential moving average is holding. We're going to get weekly jobless claims, housing starts, and building permits, which tend to be leading indicators. The Philadelphia Fed Manufacturing Index will also be coming out. And then we want to keep an eye on all the different geopolitical events. In Friday's session, we're going to get consumer sentiment. Personally, I think that's kind of the biggest report of that day. Seasonally, where we're neutral to negative, when we look at the Dow, S&P, and NASDAQ, we're also in the middle of options expiration week, where we tend to be down more than up. We're also seeing a little bit more of this choppiness during an election year, going from 1950 up to right now, or actually be 2023. So we're not seeing an awful lot of strength right now. Here, we will be on the 12th trading day of the month, where we do see some negativity here when we look at the green dashed line during an election year. Also keep in mind that in Friday's session, it will be options expiration. That can produce a lot more volume, and it can also make things go kind of wacko. We're wondering if we're even experiencing the January effect anymore. If anything, it's this big move down here that we typically see going into February, but we saw most of these gains end up happening in December. We're also chopping sideways more or less during an election year. So far we're going with that seasonally. We're also flat with the Stock Traders Almanac. That's the green dashed line. But when we have the current president running for re-election, we should be seeing more positive seasonality than what we've been seeing. Thursday tends to be one of the more positive days of the week, where it's up, where Wednesday, as we just witnessed, no matter what happens historically, at least in 2023, Wednesday ended up being a negative day. So our scenarios can't really go with the down one yet. We are shifting over and looking more negative, but so far the 20-period exponential moving average is holding. We can't really go with the up one now either because our ADX charts are turning more negative. We're kind of in between right now as the market works out what it wants to do. We're not going with the sideways trend because we are showing a weakening trend, but we're still above 20 with both our short and intermediate term ADX chart. So the warning signs, we're not really seeing an awful lot of strength here with the risk on posture. The equity put call ratio based on 5 periods is still going up and extreme and getting even a little more extreme. The vortex has now crossed over and is negative. The transports continue to negatively diverge from the Dow. The 1 to 3 month spread is still positive where it should be negative. The Copic curve is negative. Our oscillators are rolling over after being extreme positive, and each one of them are now below their moving average and declining. The momentum for the NASDAQ 100 is still negative. The positive signs, we're still seeing growth hanging in there for right now. Where it was MIA a few weeks back, it's still holding up for right now. That could be positive once the market gets done working through what it's been working through now. The daily special K chart is still positive. The longer-term equity put call ratio based on 253 periods, it has been going down, but it's just ticking back up now slightly. The parabolic SAR chart continues to be positive. Now, if we see more weakness in Thursday's session, especially significant weakness, this could change back over to negative. The bullish percent index is extreme positive, but it is coming down now. And we're just barely coming out of extreme positive territory. The Zohorchek method has not changed. We're still dealing with a longer-term uptrend when we look at the Russell, the small caps, and the mid caps. And I showed you the charts of small and mid-cap growth, where it is positive with mid-cap growth actually showing more strength. The financial sector is positive, but has been pulling back. Our 50-period exponential moving average of the new highs, new lows study is still going up overall. So our conclusion, we are positive, but showing some weakness. But so far, the 20-period moving average is holding. That's what we're going with right now in the short term, and we already have a couple of extreme negative readings. In the intermediate term, we also have a couple of extreme negative readings, but we still have a lot of overbought readings at the same time. We're still maintaining a positive stance. We're above the 50-period moving average. We're still positive in the long term. Even though we're coming down with those longer term moving averages, we are still in the extreme positive there. But we're also positive because we're above the 200-day simple moving average. Thank you. I really hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.